You are watching Market Pulse Daily. Today is Wednesday, May 27, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. U.S. stocks overvalued. Global investor warns of capital flight to emerging markets and commodities. Today's agenda: the global spending supercycle, the resource revolution, Bitcoin's new role, market sentiment and risks, the resource rebound and gold's rise. We begin with a bold call on the U.S. market. Global investor Pelosky is sounding the alarm. He believes the U.S. market is simply too expensive right now, trading at a premium that doesn't reflect its growth potential compared to the rest of the world. Pelosky predicts a significant capital rotation. Money is expected to flow out of the U.S. and into regions like China and Europe, which he sees as cheaper and faster growing. The catalyst: a colossal global spending spree. We're talking about a $10 to $16 trillion spending supercycle, all focused on artificial intelligence, defense, and clean energy. This isn't just a short-term trend, it's a secular shift. The days of the U.S. market being the sole engine of growth are over. Instead, we're entering a multipolar world where regional integration and industrial spending will drive asset prices. This means traditional bonds might struggle, but commodities and stocks outside the U.S. could see robust earnings growth. Keep an eye on those non-U.S. markets and hard assets. They're poised to be the big winners. As always, keep an eye on gold and silver as traditional safe haven assets, and on Bitcoin as a faster-moving indicator of liquidity conditions and risk appetite. This global shift is also driving a fundamental change in resource acquisition. There's a major strategic shift happening in the U.S. We're talking about reducing our dependence on China for critical minerals. The government is converting grants into equity stakes and bringing in private money to build up our own supply chains. This is a generational change. Investment capital is moving away from the digital world, from the metaverse, and pouring into physical mining and extraction. Think deep-sea mining for nickel and manganese, and securing iron ore for reindustrialization. The U.S. simply doesn't have enough of these minerals at home, so the strategy involves new technologies and new partnerships. Companies that provide financing through royalties and streaming deals are expected to do very well. They offer strong cash flow with less risk than direct mining operations. This is all about building a more secure economic future, powered by essential resources. The dollar remains a key variable here. A stronger dollar tends to compress commodity prices and weigh on emerging market assets, while a weaker dollar does the opposite. Meanwhile, a groundbreaking innovation is happening in the crypto space. Yet this Strive has just launched something truly groundbreaking. It's called SATA, and it's the very first security in history that pays dividends every single day. The goal here is to rebuild trust in our financial systems. How? By using Bitcoin as the underlying asset. They believe this can help stabilize things like 401(k)s and even credit markets. The potential market for this is enormous, possibly hundreds of trillions of dollars. SATA is structured to give investors a 13% annual return, funded by the company's own assets and its Bitcoin holdings. This is a huge step. It's moving Bitcoin from just a speculative play to a core component of traditional financial products, offering a stable yield while still capturing some of Bitcoin's upside. This could unlock a massive amount of institutional money that has been hesitant to enter the crypto space. Real yields are worth watching closely. When real yields rise, growth assets like stocks and crypto tend to struggle. When they fall, hard assets like gold tend to benefit. But beneath the surface, significant risks are brewing. Now let's talk about the market's current mood. It's being described as an AI and tech-driven melt-up. Think of it as a party fueled by easy money and a very strong narrative around artificial intelligence. But here's the catch. While stock prices are soaring, the underlying economic fundamentals are actually weakening. This creates a dangerous divergence. On one hand, we have soaring valuations, which is good for short-term risk-on sentiment. On the other hand, there's a growing warning about an impending hard landing, a potential debt crisis, and a massive shift into physical assets. The current rally is driven by AI boosting corporate profits, but it's also leading to labor displacement and a huge increase in new stock issuance, which can dilute value. This rally is concentrating wealth in a few mega-cap tech companies, and that's not sustainable. The market is showing extreme complacency. This meme rally is recycling money into AI hardware, not reflecting true economic health. It's a fragile situation, and if liquidity dries up or the AI story hits a snag, we could see a very sharp correction. From a cross-asset perspective, the relationship between equities, bonds, and commodities is telling us something important about where institutional money is positioning. And in this environment of uncertainty, hard assets are shining. In stark contrast to the tech rally, hard assets are showing significant strength. Peter Schiff is very vocal about the US facing an inevitable sovereign debt and dollar crisis. He believes inflation expectations are completely unanchored, and fiscal irresponsibility will lead to major problems. He's not seeing a soft landing here. Schiff points out that gold and silver have already broken through key resistance levels. Silver, for example, has hit a 40-year high, and he sees it's about $125 peak as just the first stop. He's very bearish on Bitcoin, calling it a Ponzi scheme, and predicting a massive flight of capital from crypto and bonds into physical gold and silver. This is where investors are looking for safety. The US bond market, he argues, is not pricing in the real risk of a sovereign debt crisis. If the Federal Reserve is forced to print money to cover that debt, yields will skyrocket, so gold and silver are acting as essential inflation hedges and safe havens. Gold is holding strong above about $4,500, boosted by central bank buying and global uncertainty. Silver is outperforming, driven by industrial demand and breaking through major price barriers. This is a clear signal of investors seeking tangible value. In the options market, implied volatility is a useful gauge of how nervous or complacent traders are heading into the next catalyst, worth monitoring if you trade around events. Today, we've seen a stark warning about the US equity premium, a deep dive into the generational shift towards physical resources, and the innovative integration of Bitcoin into traditional finance. The message is clear. The world is changing, and so should your investment strategy. Thank you for your attention, and we will see you again tomorrow. For longer-term investors, the macro backdrop matters more than any single day's move. Focus on the trend in central bank policy, credit conditions, and earnings momentum. On the geopolitical side, supply chain dynamics and energy flows remain underappreciated drivers of inflation and corporate margins in the current cycle. Central bank communication will be closely watched in the sessions ahead. Any shift in language around inflation, growth, or the pace of policy normalization could move markets quickly.